Let's chat about commodities now, where we have seen the crude oil prices come under a bit of a pressure. Remember, there have been very strong fundamentals, and the crude prices in every week of this year until now have posted stronger gains. But on your screens, it's nearly 0.3% of a decline that we are seeing. But even with that, 66 and 56 are holding respectively for both the crude varieties. Joining us to talk more about that space now is Paul Hickins of S&P Global Platts. Paul, hi. Thank you so much for joining us. What has been your sense? I mean, with a bit of a decline today, even that we are standing with more than 20% gains in 2019 until now. Would you say much of the positive factors are by now into the price?
Well, I think it's a bit of the parable of the boiled frog. We're seeing prices creeping up. It really is. The story really has been these OPEC cuts, along with these sanctions on Iran and Venezuela that have been driving these cuts and that have been providing a floor under the prices and pushing them up gradually. But they haven't been going up as quickly as maybe some people imagine, because for several reasons, really. One, you've still got the threat of shale and U.S. production. It's posting record highs. That's partly offsetting that, at least in volume terms. And then you've got the concerns, the jitters around the demand outlook, the global economic concerns. That's also providing a ceiling. And then you've got the fact that traders, the market is still a little bit, what we'd say was a bit sort of intrepid, a bit nervous about the geopolitical risk factors, especially since the fact that the backdrop against that $86 barrel rise, people talking of $100, and then that big U-turn on Iran sanctions and the drop down to $50 a barrel, a lot with the Donald Trump tweets, that has still played a narrative in the backdrop of people concerned about pushing prices in too far, too quickly in one direction.
Yeah. So, Paul, would you say that the easing supply as a fundamental is now into the prices, better demand going forward also is now into the prices? What can really be the concerns or hiccups going forward from here?
Well, you've got to say that while it is being baked in, those cuts, you've got to remember that Saudi Arabia is pretty much single-handedly providing those cuts. They've overcut more than 1 million barrels a day. That's close to the 1.2 million barrels a day that OPEC pact said they would cut over that time. So you've got to they've been really leading by example, and they've been really giving the market a jolt to get those prices up. But you've got to say that there's still the key factors to look out for is what's happening with Venezuela, what's happening with Iran. In the near term, it's Venezuela that's going to be dominating the headlines, but a little bit further out, you've got to be looking at Iran as well. How many of those sanctions waivers are going to be extended beyond the May deadline? Sure. And what we're getting, the sense we're getting is it could be that the Asian countries still allowed to sort of buy some of that crude. It's very difficult to say it right now, but it's also the fact is that you've got to say that those sanctions are going to be a sort of a function of price. The fact that where prices are going to be when that deadline hits is going to be influencing policy decisions. So that's also going to be something that the market's going to be looking out for.
I was reading a report, Paul, which said that for the next 5 years, we perhaps are going to be trading within that $50 to $70 per barrel mark for the crude oil prices. I understand it's slightly far-fetched with the kind of uncertain world that we live in, where it's difficult to predict even the next quarter. What is your sense, though? Is there a range for this year, next year? What are you working with in sense of prices broadly?
The market consensus really is for a $60 to $70 range right now. I think anything beyond the current few months, I think you'd need a crystal ball for, to be honest. There's a lot of factors. You've got to remember that if you start looking further out, you've got the IMO sulfur cap. What is that going to have on prices when that kicks in 2020? And while it's been seen as something that's going to affect the shippers and refiners, that's going to have a knock-on the oil price. And that is something that if people aren't alert to in the broader oil markets, they should be by now, because that is going to have a knock-on effect. You've also got to look out at things like the electric vehicles. What's going to happen with policy moves around the world in terms of the transition away from oil to gas, to LNG, these kind of aspects as well. But also remembering that the question around where is the oil demand going to come from if the electric vehicles is replaced, which is things like petrochemicals. That's also a big factor. People, petrochemicals in everything we do. We've had this sort of environmental backlash against plastics, especially in the Western world. But you've got to remember that is still going to make up a big part of the demand factor because it's in everything, and it's something that you see in the Middle East and across the world is that they're changing refiners so they can actually produce much more of this product and cope for this changing way that oil's demand is going.
That point is well taken. Paul, thank you so much for taking time out. So that really is the view coming in from S&P Global Platts. Saudi Arabia, of course, is single-handedly ensuring that the OPEC cuts actually take place and impact the prices. 60 to 70 is what he's expecting. We will see as Brent ranging within for the foreseeable future. But with that, that's all the time on this edition of Closing Bell. After the bell comes up next.
Brought to you by